Good morning, everyone. My name is Amit Kumar Singh, and welcome to next class on derivatives. So, in this class, I'm talking about options. So, already we have started discussing about options in the previous class. So, I believe you still remember what all we have done in the last class in regard of options. So, you need to understand how you can differentiate between forward contract, future contract, while the option contract. So remember one thing, that whenever you talk about forward contract, or if you talk about future contract, if you talk about forward contract, or if you talk about future contract. So in the case of forward contract or in the case of future contract, you have a possibility of linear payoff diagram. You have possibility of linear payoff outcome. So payoff basically means result. Why in the case of forward contract and future contract you have the possibility of linear payoff? Because there's a condition of getting unlimited profit and unlimited loss. So future contract and forward contract, they basically works on an obligation. So whatever is the obligation, you need to follow that obligation. So whenever you talk about future contract, whenever you talk about forward contract, you have a linear payoff outcome. While whenever I talk about option contract, well, when I talk about option contract, so in the case of option contract, there's a possibility of non-linear payoff. So whenever I say option contract, in the case of option contract, there's a possibility of non-linear payoff. So while in the case of forward contract and future contract, you have the possibility of a linear payoff, but in the case of option contract, you have the possibility of non-linear payoff. You need to understand this part. This whenever we talk about option contract, in the case of option contract, I hope you remember the long position holder has right, but no obligation to follow the contract in the future. Okay, so in order to enjoy that right, but no obligation to follow the contract in the future. So what the long position holder do? So at the beginning of the contract, the long position holder pays an amount to the short position holder, that is called the initial premium. So whatever the initial premium the long position holder pays to the short position holder, that is the maximum profit what the short position holder can get. While whatever the initial premium the long position holder paid to the short position holder, that is a maximum loss what the long position holder can get. While the maximum profit possibility for long position holder is unlimited, while the maximum loss possibility of short position holder is unlimited. So you need to understand how we can differentiate between future contract, forward contract, and option contract. So they are very important to understand the option contracts. You need to understand derivatives. So they help us to understand derivatives in much more better way. Okay, so guys, I hope you are understanding the logic, what logic we are talking about. So whenever we talk about derivatives, whenever I'm talking about derivatives, in the case of derivative, we are talking about a transaction which will do in the future based on the present determined condition. So that is derivative. So in the case of derivative, you don't have buyer, you don't have seller. In the case of derivative, you have long position holder, you have short position holder. So the long position holder is the person who commit to buy the underlying asset in the future. The short position holder is the person who commit to sell the underlying asset in the future. So in the case of option, you have long position holder, you have short position holder. In the case of future contract, in the case of forward contract, in the case of options, whenever we are talking about them in the form of derivatives, so derivatives is all about the transaction what we'll do in the future based upon the present determined condition. So the price what is being fixed, so the price what is being fixed to undergo the transaction in the future, that is called exercise price. The same exercise price in the case of options is called a strike price. Okay, so remember these terms. So these terms will be very important for you. How to differentiate a future contract, how to differentiate future contract from a forward contract, you need to understand them. That future contract is the forward contract which trades over the exchange. So whenever the future contract starts, both the long and short position holder, they have to pay money to the exchange. That money is called as the initial margin. So this initial margin is like a token or the collateral of which both the long position holder and short position holder, they pays to the exchange at the beginning of the contract, with the exchange do mark to market settlement. So this M2M settlement exchange follow every day till the maturity of the contract. That is the future contract where exchange guarantees the counterparty risk. But either you talk about future contract or either you talk about forward contract, you have the obligation to follow the contract in the future. But in the case of options, so the person who take long position does not have the obligation to follow the contract in the future. Okay, so basically, whenever I try to calculate the profit and loss for the option position holder, so if I talk about the payoff value, so for the long call, so the formula what we follow is maxima of ST means final stock price minus K comma 0 minus P. So this is the payoff metrics or payoff calculation for the long call holder, while the for the short call holder, the formula is P minus maxima of ST minus K comma 0. Similarly, for the long put holder, the formula is maxima of K minus ST comma 0 minus P. While similarly for the short put holder, similarly when I talk about short put holder, the formula is P minus maxima of ST minus K comma 0. So this is about the payoff calculation for long call, short call, long put, short put position holder. Okay, remember this formula. We use this formula for calculation of payoff depending upon the different option trading strategies. Okay, so basically, whenever we are talking about the options contract, whenever I'm talking about the option contract which trades over the exchange, such kind of option contracts are basically called as plain vanilla option contracts. Okay, these plain vanilla option contracts, whatever we are talking about, they can be either call option or they can be either put option. Okay, so whenever you talk about these option contracts which trades over the exchange, whenever I'm talking about these option contracts, so this option contract, whenever I'm discussing about these option contracts, so they can be either call option, they can either follow call option, or they can either follow put option. Okay, so under call option, they can be having long call or they can be either having short call. Okay, similarly under put option, they can be having long put position or they can be having short put position. Okay, so whenever the option contract starts, both long put holder pays an amount to the short call and short put holder. That amount is the initial premium, because long position holder have the right but no obligation to follow the contract in the future. Okay, so you can remember call option means optimistic, someone who believe that the market will go up in the future. You can remember put option as someone who is pessimistic. Pessimistic spelling can be wrong. Pessimistic. So pessi. So put option you can remember with someone who's pessimistic on the market. Okay, and then what you remember? Remember call option with someone who's optimistic. Remember put option with someone who's pessimistic. Okay, now the next thing you can understand, you can associate call option with optimism. You can associate put option with pessimism. Now, as you are understood, whenever I say call option, whenever I'm talking about call options, you can understand whenever I'm talking put option, you can understand I'm talking about optimism and pessimism, because whenever you trade on the market, either you are optimistic on an underlying asset or you are either pessimistic on an underlying asset, depending upon lot of factors, macroeconomic factors that ultimately affect the value of a particular underlying asset. Okay. Now you can understand that the options are biased toward the long position holder, as you can easily understand that the options are biased toward the long position holder. So whenever I'm saying call option means optimistic, so you can put long call as a optimistic. So you can put long call as optimistic. Similarly, if I'm saying put option as pessimism, so you can put long put as pessimistic. You can put long put as pessimistic. So automatically, if long call is optimistic, so there's other person who's taking the position against it. So definitely the other person should be pessimistic. Definitely the other person should be pessimistic. Similarly, similarly, as I put long put as pessimistic, definitely the other person should be optimistic. Okay. So I hope you can understand. So now, if you are bullish on the market, or if you're optimistic about the market, so what you can do, if you're optimistic on the market, so what you can do, you can either take long call or short put. If you're pessimistic on the market, then you can take either long put or short call. So you can understand that while trading, you can use this strategies. Like if you believe that the market go up, if you believe that the nifty, if right now you believe that nifty can go up, so if you believe that the nifty can go up, then you can either take long call on nifty or you can take short put on nifty. So if you take long call on nifty, you need to pay a premium, and if actually the nifty went up, then you will end up in booking unlimited profit. But if thing does not happen the way you thought, then you lose the premium whatever you paid. Similarly, if you are pessimistic on certain stocks, certain sectors, if you believe that because of corona epidemic they may not will perform well, so if you are pessimistic on them, though, so what you can do, you can either take long put or you can either take a short call. So you need to understand taking short position creates a lot of risk for you to get unlimited loss. Also, there's a downside risk is unlimited. Automatically, the margin what the broker will charge from you would be very high. So be careful on them whenever you take position in the market. See, so premium is not so easy to work on. The traders, when they trade in the market, they trade for premium only. So you have to understand the game of premium. So imagine if this is the present stock price. So many traders, many investors, what they do to trade on the premium. So maybe suppose Nifty is right now trading at 11,300, and so what I can do, so 11,300 Nifty is trading. So what I can do, suppose 11,000 I took a long call. So at 11,000 I took a long call. Okay, so at 11,000 I took a long call. Okay, so I'll pay the premium called P1. Then premium is the game here. You need to understand you can trade on premium. Paying premium is not such a easy deal to work on. For majority of trader, a premium plays very significant role. So what you can do, that in every case, that Nifty will not go beyond 11,600. So what you can do, at 11,600 you can take short call. So ultimately your total cost would be P1 plus P2. So where that P1 would be more than P2. So so ultimately what you did, you have reduced your cost because you took long call and you took short call. So thereby what you did, you have somehow reduced your cost. Okay, so because P1 you paid and P2 you received, so ultimately now your total cost become uh, P1 minus P2, that is your total cost. Okay, so thereby what you did, you reduced your cost. So once you reduce the cost, so then it comes with a it comes with a payoff net setup also, that this is called bull spread. This is one of the example I've given. So whenever you trade on bull spread, so along with you reduced your losses. Loss means your cost in the term of P1 minus P2. Instead of your cost being P1, now your cost become P1 minus P2. So at the same time, you have to understand that now you are not entitled to receive unlimited profit. Your profit possibility also get limited. So this is one of the trading strategy. This is called bull spread. So the lot of trading strategies are there: bull spread, bear spread, you have butterfly spread, you have straddle, strangle. So a lot of trading strategies are there. More you try to learn about them, more you'll understand these trading strategies, which you actually imply on the real market, and that way it would be more, what you say, the learning part for you. So, I just an example I have given you. So it's premium. Working on premium is not such a luxury thing. For many people, when they see option contract, they think that option contract is very easy to work on. They just need to pay premium, and then they get the possibility of unlimited profit. But they need to understand that you pay something as a premium. So in every case, you have to recover that premium also. Okay, so you need to understand that depending upon whenever you're entering into the option contract and whatever the strike price you take, so the strike prices can be in any form. They can be 313, or they'll show you 414, or they'll show you 515. So you need to understand what do you mean by 313 or 414 or 5515. I just give you an example of 313. So maybe I'll take one example. Maybe there's a company, maybe there's a company called ITC. Maybe there's a company called ITC, and the ITC stock right now trading at 230 rupees in the market. I just gave you an example. Suppose there's a company called ITC, and its stock is trading at 230 rupees in the market. So the exchange will tell you that if you want to take option contract on ITC, you can take on different strike prices. You can take on different strike prices. So those strike prices, maybe they are in the interval of 5 rupees. And suppose if they are in the form of 313, it means you will get three in the money. You will get three in the money strike prices, one at the money strike prices, and three at the money strike prices. Just an example of 313. Like that, it can be 414 or 515. So three in the three 313, it means you when you check the strike prices, there would be strike price called 230, then 225, then 220, and then 215. Okay, then your strike prices can be 235, it can be 240, or it can be 245. So this would be your strike prices. Okay, so your present spot price is 230. So your present spot price is 230. So you can choose any strike price depending upon whatever is your perception about the stock likely in the future. Because for the initial financial derivative market, you can either take 1 month contract or 2 month contract or 3 month contract. Now, based depending upon the difference between in the money, at the money, and out of money. So if S is more than K, this is in the money. This is in the money. This is in the money. This is in the money call option. So I'm talking about which kind of option contract. If you take call option, it is in the money. So this is at the money. This is out of money. So this is out of money. Similarly for put option. Similarly, if I talk about put option. Similarly, if I talk about put option. Similarly, if I talk about put option. So for the put option, they can be out of money, out of money, out of money, then at the money, then in the money, in the money, in the money. So you need to understand. So it depends upon the call options and put option. So already I have discussed about, this is just a name. So they can be in the money, at the money, or out of money, depending upon the option contract, whatever you take. So in the money, in the case of option contract, it happens when S is more than K. At the money means when S is equal to K. At the money, out of money, when K is more than S. Similarly for the put option, we say in the money when K is more than S, when S is equal to K, and here when S is more than K. So you need to understand this part. Now, whenever you see the payoff outcome, you need to always understand an option contract holder will always exercise the option contract if an option contract is expiring in the money. So the ideal strategy to trade. So the ideal strategy to trade. Ideal strategy to trade to trade ideal strategy to trade an option contract, to trade in the option contract is to enter out of money, is to enter out of money into the in the contract and exit in the money, and exit in the money from the option contract, from the option contract. So you need to understand this part. I'll make you understand this. uh, first thing uh, first thing I'll focus on how you how what this exit in the money from the option contract, because that is very easy to understand. As you remember, for long call and long put, as you remember the formula what I wrote, made you to write for long call and long put. So this formula is maxima of st minus k comma 0 minus p. Here the formula is maxima of k minus st comma 0 minus p. So by looking at this, you can understand that when you'll exercise the option contract here, in the case of put option, when k is more than st, and similarly for call option, when s is more than k, means st is more than k. So means this is what, when s is more, st means the final stock price. So s and st, don't get confused with that terminology. Both are synonyms. So ST is more than K means what? This is in the money. Are you getting me? So this is in the money. When K is more than ST, in the case of put option, what is this? This is in the money. So you need to understand, whenever you exiting, you should always exit. You should always try to exit. Whenever you exiting, you should always uh, try to exit from the option contract whenever you are when the option contract is expiring in the money. In case if it expiring out of money, means you never exercise the option contract, because there you are getting losses. So you'll understand more practice if you'll do. You'll understand gradually what I'm talking about. Now the problem here is that, as like I give you this example, I give you this as an example. You have to understand this part, that like suppose there's a stock is 230 rupees. Suppose the stock is 230 rupees, and you can choose a strike price of 235 rupees or 240 rupees or 245 rupees. Whenever you are taking call option or put option, you can choose here 225, or you can choose here 220, or you can choose here 215 here. So guys, you need to understand this as very important thing. Suppose this is the payoff, P1 is the premium what you paid. Now automatically you need to understand, as I told you in the beginning, or from last class also I told you, that whenever the option contract starts, the long position holder pays in premium to the short position holder. Whatever the premium the long position holder pays to the short position holder as in premium, that is the maximum loss what the long position holder can get. But you need to understand, as a long position holder, you can choose any premium, you can choose any strike price from 215 to 245. Okay, so right now the stock is trading at 230. So more in the money option contract you choose, more in the money option contract you choose, more in the money option contract you choose, more the premium you need to pay. So less in the money option contract you choose, less premium you need to pay. So you need to understand this. So you have to understand the concept of premium. You have to understand that this premium depends upon whenever you talk about premium, this premium depends upon the difference between the spot price and strike price. Although the premium depends on a lot of factors, so the factor on which the premium depends, if I ask you, so the factor on which the premium of the option contract depends. So the premium of a option contract depends. If I ask you these factors, the factors on which the premium and option contract depends, it depends upon the stock price. Okay, it depends upon the strike price. It depends upon the spot price. It depends upon the strike price. Okay, so the difference between the stock price and strike price, that ultimately determines an option contract, either as in the money or at the money or out of money. And then based upon in the money or I at the money or out of money, we decide the type of option contract. Premium depends on them. Along with that, the option contract depends upon lot of factor. Then option contract depends upon the risk free interest rate. risk-free rate of return, that is RF. So the option contract depends on this. Then the option contract depends on the volatility. So then the option contract depends on the volatility. So volatility, we measure volatility within factor called standard deviation. Okay, then the option contract depends upon time to expiration of an option contract, time to expiration of an option contract. Okay, so these are the factors on which the option contract depends upon. So ultimately, these factors ultimately affect the value of the option contract. So 1 minute, let me drink water. So as if you try to measure the impact, so the actual stock price, what is happening in the underlying market, so what is the movement on the underlying stock price ultimately is affect the premium for the option contract. So if you're trying to measure, if you're trying to measure the impact, if you want to measure the impact, if you want to measure the impact of change, if you want to measure the impact of change in underlying asset price, in underlying asset price on the value, on the option premium, if you want to measure that, if you want to measure the change, if you want to measure the relative change, then the best tool to measure that is called delta. So you can work on the delta, you can calculate the delta for the option contract. So the delta of the option contract will tell you this impact. Okay, 1 minute. So the delta of the option contract will tell you this impact. Basically, we understand these tools like delta, gamma, theta, vega, rho, phi. We study all of them under Greek letters. So you can study all this thing under Greek letters, and you to understand them in much more better way. You can understand them. 1 minute. Uh, Let me search Greek letter. So you understand them in the case of Greek letter. So basically, so mathematically, there's a formula for doing all these calculation. So if you are trying to calculate them, so there's a formula to calculate everything. So how you can do that kind of calculation? So how you can uh, do that? So 1 minute. So you can see this. So whenever I talk about delta, so the delta for option, basically for call option, it is between from 0 to 1, while for the put option, it is from -1 to 0, while delta for the option, it is between -1 to +1. Okay, and for at the money option, it is 0.5. For deep in the money, it is near +1 and -1. For delta for non-dividend paying European call option, that formula is ND1. So one theory question came once where they are asking you about Greek letters. So we call them as a Greek letter to understand the impact of different factors on the premium on the option contract, that we understand them in the form of Greek letters. So this is the formula. These formulas are all not important for you for non-dividend paying European call option, which does not pay dividend, while the delta for non-dividend paying European put option, this is the formula. Okay, for such kind of call options and put option which pays dividend, this is the formula for them. So basically, what delta basically do? Delta basically talks about the impact on the premium of the option contract because of the change in the underlying asset price. So how the premium on the underlying asset price that get affected because of the change in the underlying asset price. So that is basically called as delta. So this is suppose change in underlying asset price, change in underlying asset price. This is basically change in underlying asset price, and this is the change in the option premium. So this is basically called as delta dy by dx. Those who understand maths, dy by dx, that is called as delta. So this is a mathematical statistical tool which measures this change. But actually, if you see this change, it is not actually straight line. Like if you remember convexity, duration, and all in the bond mathematics, somewhat similar to that. This change is not actually a straight line. This change is somewhat like a convex kind of line. So then we use another term. So we use another term there, that is called gamma, because what we have noticed, that small change in underlying asset price will bring small change in the premium of option contract, but large change in the underlying asset price does not bring large change on the premium of option contract. So that means that relationship is not linear. It is somewhat somewhat convex relationship. That convex relationship is ultimately measured by gamma. So we measure that with an statistical tool called gamma, where gamma measures the change of delta. 1 minute, just have everyone please read this. You'll understand what gamma is all about. So basically, GABA bases the change in delta. So GABA is basically second order derivative of the change in the premium of an option contract with respect to the change in the stock price, or you can measure the GABA bases the change in delta. Basically, GABA bases the change in delta with respect to the change in underlying asset price. So change in underlying asset price. So that is basically GABA talks about. So that is what the relationship we are talking about. So this is the formula to measure the GABA. So this is the formula to measure the GABA. Okay. So this is the formula where here you can see a term called N dash D1. You can see a term called N dash D1. So how to calculate this N dash D1? So this is the this is the calculation. Okay, one minute. This is the sorry. So this is the GABA for this is the GABA for the dot dividend paying stock. This is the GABA where dividend yield is there. So what is N dash D1? This is the formula. Okay, one minute. Where is N dash D1 formula? dash d1 formula is given somewhere. Uh, so what? Where is the formula for at dash d1? This is the formula for at dash d1. So from this we calculate the at dash d1. So that is basically the GABA. Then, so I talked about delta, I talked about GABA. Then the next factor is theta. So theta is basically is the factor which measures how the change in expiration of the option contract, how that measures the premium of the option contract. So time to expiry, that as the option contract reaches towards expiry, so how the premium of the option contract changes because of that. That is basically called as theta. So this is the formula for theta for the call option. Okay, this is the formula for the theta for the put option. This is the formula if the dividend yield is there. So this is the formula for theta and all. These formulas are not much important for you. You should know these terms like delta, gamma, theta. What are these terms? This is the calculation. Uh, all these calculation already have done. Then so gamma, theta. Then there's a factor called Vega. So Vega basically measures how the underlying asset price is being impacted because of the volatility in the market. Volatility which is measured by standard deviation or implied volatility. How that ultimately impact the premium for the option contract. That is what we measured. That is what we measured in the term of Vega. So this is the formula for Vega. This is the formula for Vega for non-dividend paying stock, for non-dividend paying stock. And if dividend yield is given, so this Q basically means a dividend yield. Whenever we talk Q basically means dividend yield. So this all calculation you can see all this. Okay, so these calculations are not important for you. While rho measures the change in the interest rate, how the change in the interest rate ultimately affect the premium for the option contract. That is basically called as rho. I have done an Excel calculation for all that. I don't think you people will be interested for all this. This in MS Excel, I have done all these calculations with an example. I have done all this calculation with an example. Same thing I have done in R also. So same thing I have done in R also. So if you are aware about how to work on R, so I already developed a video of how you can do all this calculation on R. If you would be interested, you can watch my video that is already available in playlist. So these factors are basically we called as a Greek letters, and these factors, as in Greek letters, they impact the the value of the option contract. So these factors ultimately impact the premium for the option contract. Whenever we talk about premium, whenever we talk about premium is the value of what the long position holder pays to the short position holder at the beginning of the option contract, that we called as a premium. So this premium mathematically by considering all these factors in your mind, you can calculate this premium. So basically we have two model. One is called Black Scholes Merton model. We have one model called Black Scholes Merton model. Through this also we calculate the premium on the option contract. And there's another model called binomial tree model. So there's another model called binomial tree model. From that also we calculate the premium on the option contract. Normally we use Black Scholes model. Generally we use Black Scholes model for the European options contract, and normally we use binomial tree model for the American option contract. Okay, European options are those option contract which expires only on their maturity date. So such kinds of option contract which expires on their maturity date, they are called as European option contracts. Whereas such kind of option contracts which can be expired anytime before the maturity or on the maturity date, they are called as American option contract. Okay, so So whenever I talk about black schools model, so if I'm talking about black schools model, so this is the formula for black schools model for non-dividend paying stock. So first we find the value of D1 and D2. First we find the value of D1 and D2. Once we found the value of D1 and D2, then I'll find the value of ND1 and ND2, N minus D1 and N minus D2 to find the value of N minus D1, N minus D2. Excel, through Excel, you can use norm dist function in Excel to do that. Otherwise, you need cumulative normal distribution table. Otherwise, you need cumulative normal distribution table to calculate that. Otherwise, you need cumulative normal distribution table to calculate this part. If you want to calculate on pen and paper, or you can do the same thing in MS Excel also. Sorry, MS in R, MS, sorry, MSR. I'm saying you can do the same thing on R also. If you want to learn, you can watch my video on how to do all these calculations. So this is a formula for Black-Scholes model on non-dividend paying stock. Similarly, for currency option, this is the formula. In the currency option, two factors come into the picture. One is the interest rate in home country and interest rate in foreign country. Okay, so you can use this formula. The same formula we use for a dividend yield also, or index option also. We use the same formula. So this is about Black-Scholes model. So black for Bangalore City, don't ask problems on Black-Scholes model. Otherwise, all these calculation already I have solved everything, or in my video also I have solved everything in MS Excel. I have done all this solution. I have solved all these things. So if you want to learn more, you can watch my MS Excel sheet and you'll understand that part in much more better way. So again, up to you. If you want to learn more, you can do that part. Okay, then we have binomial tree model. So we can use binomial tree model also to do the same homework. We can use binomial tree model. So basically, whenever we talk about binomial tree model, so binomial tree model basically works on the risk neutral approach. So whenever you talk about binomial tree model, it works on the risk neutral approach, and in the binomial tree model, we assume a random walk movement for the underlying asset price. So whenever I talk about binomial tree movement, whenever I talk about binomial tree model, so whenever I say binomial tree model, so it works on basically the risk neutral approach. It basically works on a risk neutral approach whenever we talk about binomial tree model. So here we assume that the stock follow. Here we assume, so when the assumption of a binomial tree model is that the stock follow that the stock follow random walk hypothesis. We believe that the stock follow a random walk hypothesis. Whenever we see binomial tree model, we believe that the stock follow random walk hypothesis, in this, as the time limit becomes smaller, this model leads to log normal distribution and for the stock prices, which follows the Black-Scholes model. So basically, binomial tree model works on the concept of risk neutral valuation, which is based on the work of few economists like Cox, Robeston, and Ross. So three economists were there. Their names were Cox, then Cox, Ross, and Rubinstein. So this model is also called Cox, Ross, and Rubinstein model, and they have come up with this hypothesis in 1979. So you get problems on binomial tree model. So how we work on binomial tree model? So like suppose this is the underlying stock price. So it can either go up or it can go down. So the proportionate increase in the price of stock, that is suppose that is measured by U, and the proportionate decrease in the price of stock, that is measured by D. Okay, so if it increase by U, it become S naught U. If it decrease by D, it become S naught D. Okay, then again, this is called one step binomial tree model. So Bangalore City only asks problem on one step binomial tree model only. So here you can calculate the value of u mathematically with a formula called u equal to e to the power sigma under root del t, while d you can measure with a formula e to the power minus sigma under root of del t. So this is the formula through which you can measure U and D, where U is the proportionate increase in the price of underlying asset, while D is the proportionate decrease in the value of underlying asset. Okay, so based on this, now there's a probability that it can increase. So there's a probability that it can increase. So the probability that it would decrease would be 1 minus P. Okay, so you can understand this. Now mathematically, if I use cost of carry model, so I can write S naught UP plus S naught D into 1 minus P, that will become S naught e to the power RT. Okay, so delta T we sometimes we use. So that normally become complication happens when I talk about two stage or three stage model. So if I remove S here, so I can write U into P, then d into 1 minus p is equal to e to the power rt. So I can write up plus d minus p into d is equal to e to the power rt. So I can write up minus p into d is e to the power rt minus d. So I can say p value is e to the power rt minus d by u minus d. So this is the formula of probability. Okay, so where u and d is the proportionate increase or decrease in the value of underlying asset, and so then you can solve the problem. This is one step binomial tree. You can talk about two step or three step. So you can see here I have done all this for binomial tree model, for call option and for put option, everything I have done here. So you can see this to understand this part. But for City, they don't ask two step or three steps. So I'll not do that also because I have limitation of time to cover everything. So here let's do one problem to make you understand that part. Hmm. So you can see this question number 11. So So you can see the current market price of equity share of a detergent limited is 420. This is 420. Within a period of 3 months, the time is 3 months. The maximum it is expected to be 500, or it can go minimum it expected to be 400. So this is S naught. This is S naught U. This is S naught U. This is S naught B. This is your S naught. Okay, so with this I can find the value of U. U would be equal to S naught U divided by S naught, means 500 divided by 420. This is the U value. So this is 500 divided by 420. This is U value. D value would be similarly 400 divided by 420. So this gives you the value of D. So find what is U, what is D. So U is basically, what is U? That is 25 by 21. This is 20 by 21. So this is 20 by 21, and this is 25 by 21. So you got the value of U. U would always be more than 1, and D is always less than 1. If I don't give all this, if I give plain paper, so you can calculate U equal to e to the power sigma root of del t, and D is equal to e to the power minus sigma under root of del t. So all this City won't ask so difficult part. So you can do it very simple. So you can do that. So the risk-free rate of interest R is given 8%, and so time is 3 months. So they're asking you this where the strike price is 450 rupees. So here the strike price is 450 rupees. So if the strike price is 450 rupees, what you can do, calculate the value, calculate this value. This value, this is called FU. So calculate this value. This is called FU. This is called FD. So ultimately, you have to calculate the value of F naught. Okay, so what is the value of FU? So you strike price is 450. So you can what you can calculate FU. FU is maxima of, this is call option. No? Okay, they are talking call option. So okay. So FU means maxima of ST minus K comma 0. So the value of FU is 500 minus 450 comma 0. So 500 minus 450 is what? 50 comma 0, which is bigger number 50. So the FU value is 50. Okay, what is FD? FD again the same thing. So FD would be maxima of ST means 400 minus K is 450 comma 0. So which is bigger value, minus 50 or 0? So the FD value is 0. So FU value is 50, FD value is 0. Okay, you done with this? Yeah. So ultimately you just need to find the value of probability, and this would be 1 minus p. So how to find the probability? So already I have told you the formula of probability in past, e to the power rt minus d by u minus d. This is the formula of p. E r is what? R is given what? R is 8% and time is 3 months. R is 8% and time is 3 months, minus d. D is how much? 20 by 21. So 20 by 21 divide by u is 25 by 21 minus 20 by 21. Okay, so definitely this value will be given in exam. This value will be given in the exam. So you can do that part. You can just check that value. So e to the power 0.08. So 0.08 into 3 by 12. 3 by 12 means 1 by 4. So this is e to the power 0.02. E to the power 0.02 will be given in the exam. So this is given 1.0202. 1.0202. Otherwise, I can just check 0.02. That value is given 1.0202. Other, if suppose, if imagine if the examiner forget also to give this value, that also I have taught how to do this. I think in one of my previous video I have explained how to do this calculation without using scientific calculator in a normal calculator. Only thing you have to remember, the value of E is 2.71828. E is basically called as Euler number. So if you know this value, then you can calculate everything. If you watch my previous video, everything you'll understand. So the e to the power 0.02 is 1.0202. That value is given in the problem 1.0202. This is given already 1.0202. So the value of p is 1.0202 minus what is 20 by 21. So you can use calculator for that part. Normal calculator will give you that value. So 20 by 21, so 20 by 21, that is 0.9524. 0.9524. So 0.9524 divide by, this is 5 by 21. So this is 5 by 21. So this minus this. This is your numerator. That you can do with normal calculator. I'm doing MS Excel, so please don't get confused with that part. This is 5 divided by 21. Okay, so this is my numerator, divided by this is my denominator. So this I got 0.2848. Point. Hmm. So I get 0.2848. So the p value I get is 0.2848. So this is the p value I'll get. So I'll get p value. So then you can find 1 minus p also. Now the next thing here, in the case of binomial tree model, so if you understand basic maths and all, if you're good in basic maths, it's good. Otherwise, you can simply by heart the formula. You have to understand that you just working on a risk neutral approach or working on binomial tree model is like you're working on decision tree model, where if you remember in the decision tree model, once we used to find the end value, terminal value, then we used to come back and we used to find the present value. So there we used to use compound interest, but in derivative we follow continuous compounding. So here I'll to determine the present premium. So I'll determine the present value. So the present value formula is e to the power minus rt into future value. Similarly here, the this we represent as f naught. F naught means the initial premium. So that what I used to represent with pp. So normally in binomial tree model, in every books on derivatives, you see the symbol called f naught. So we'll see f naught equal to e to the power minus rt p into fu plus 1 minus p into fd. Okay, so f naught. So e to the power minus rt, e to the power minus rt. Okay, so you need to find e to the power minus rt. So e to the power minus r. R is what? 8%, and time is 3 by 12. Okay, p is how much? P is p is 0.2848. So p is 0.2848. P is 0.2848 into fu. Fu. What is the fu value? So what is your fu? So what is fu? This is fu. Fu is 50. The fu is 50 and plus 1 minus p means 1 minus 0.2848 into fd. Fd is 0. Fd is 0, then that you can check here. So this will give you the f naught value. This is e to the power minus 0.02 into this you can calculate. Okay, so 0.2848 into 50. So into 50. So 14.2422. 14.2422 plus 0, because 0 multiply with anything is 0. So this is the value of f naught. Now if you notice in the question paper, e to the power minus 0.02 I think is not given. E to the power only 0.02 is given. That Bangalore city people can do all this thing. So you can understand this is nothing but 1 divided by e to the power 0.02. If you understand basic maths, your work will be done. So you don't have to get panic on that part. So you know this part, this is given to you. This require only basic maths. You know this is given to you 1.0202. So into 14.2422. That will give you the f naught value. F naught is the initial premium. So you'll get 13.96. So this is the initial premium. So normally in MS Excel we represent E as EXP. So you can see EXP 0.02. If you see 0.02, you can see this is 1.0202. If I check EXP into minus 0.02, okay, that is 0.9802, and that is nothing but 1 divided by this. Basic maths, if you're good with basic maths, I hope everyone can understand this. Powers and all, if you understand basic powers, so a to the power x, that is nothing but 1 divided by a to the power minus x. So the same thing. You don't have to get worry on that part. Okay, so if in the exam they are given e to the power 0.02 is 1.0202. If I want e to the power minus 0.02, that is nothing but 1 divided by e to the power 0.02. That is nothing but 1 divided by 0.0202, and your work will be done. So basically, for your exam, you will get one step binomial tree model only. You will get one step binomial tree model only. So S naught will be given. So S naught U and S naught D. So with S naught you get S naught U and S naught D. Okay. So how will you find the value of U? Or will you find the value of U? Or will you find the value of U? U is nothing but S naught U by S naught. How will you find the value of D? D is nothing but S naught D by S naught. And U will always be more than 1 and D will always be less than 1. Okay, once you get the value of U and D, okay, then next thing in this problem you have to find is the probability. Next thing in this problem you find the probability. So the formula of probability e to the power rt minus d divided by u minus d. So so you will use p for this. So this would be 1 minus p. Okay, then the next thing you have to do, you have to find the value of fu and you have to find the value of fd. F here, FUFD basically talking about it payoff. Okay, so FUFD basically talking about payoff. So for a call option, so for the call option, the FU or FD is equal to maxima of ST minus K comma 0. While for the put option, if this is a problem of put option, so the formula of FU or FD, that would be nothing but that is equal to maxima of K minus ST comma 0. So once you get the value of FU and FD, then you have to find the value of F naught. The formula of F naught is e to the power minus RT PFU plus 1 minus P into FD. So this is the formula you need to use, and that is the F naught. That is the initial premium. What you have to find here. This is the F naught. So this is what you need to calculate in this kind of problem. Okay. So I hope you understood how to work on these calculations. So more problems and all I'll discuss in the next class. So if you like this class, so don't forget to click on the like button. And if you have not subscribed to my channel till now, so please subscribe to my channel. Thank you everyone. God bless you. Bye.